Hello traders, this is our swing trading course, lesson number 2, market structure and trend logic. So today we learn how to read what the market is actually doing. Why is this so important? Because most traders are losing money because they trade against the structure, they trade against the trend. They think more about their biases, their opinion, and they're not reading what the chart is telling them. So your job, your only job, is to read the chart and put aside all your opinions or your biases, because that's not going to help you. So let's go through what are the market states. You have an uptrend, a downtrend, and a range. In the uptrend, clearly visible, you have higher highs and higher lows. Here you can see that the buyers are in control. While in the downtrend, it's just the opposite. You have lower highs and lower lows. The sellers here are in control. But we also have another situation where the movement is just sideways. There are no higher highs and there are no higher lows. The price is contained between these two levels. Now, the concept of support resistance here is really important. You could see in the circles, we have resistance area where the sellers are stepping in. So the price is moving up here and the sellers are saying no, 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 and no. When you have instead here support levels where the buyers are stepping in, so the price is moving down and the buyers step in and say no, and the price moves back up. Here is a sideways movement, so we have a range. These circles that you see over here on support resistance are helping us to draw lines. But in fact, these lines are not just lines, they are zones. It's not like a concrete wall where the price hits and moves back. No, there is a little bit of leeway. So these are not exact lines, but they are zones. And then we go to the concept of pivot points. Pivot points are decision areas. They're key decision areas. You can see them here in the circles. Those key pivot points are where the price reacts, and are the pivot points that allow us to draw these lines, creating an upward, for example, here channel, or a sideways one. So these are just previous highs or previous lows or just range boundaries. They're really important because they help us to draw trend lines. Now, why we discuss these things? Because we need to just read the chart in front of us and don't think about our own opinions. So we're gonna discuss in next lessons what a top-down approach is and how important it is to look at the broad market first and then go through the sectors and then to single stocks. But the logic here is this: if the market is in an uptrend, like this example that we have here, we go to the sectors and the sector is strong. For example, let's look at this chart here. Maybe this is a sector chart. Maybe it's an ETF. And you see there is an uptrend, right? And we see the price pulling back and creating those pivots. So the price keeps going up, even if it pulls back. What do? We don't look for bears in this case. We look for longs. We look for bullish setups, for bullish stocks. And that's really important because it changes completely the way you trade. If you think about your opinion and trying to anticipate moves, you're not going to make any profit in trading. But if you use this approach, checking the market first, then the sectors, and go down to single stocks and just trading with the trend, then you're going to be very profitable. Next lesson, we're going to go more in depth on this concept, but that's it for now. See you next time.